All right, so I think this is the question we're all trying to figure out. Does this hawkish cut, the potential of it at least, what does this mean for the markets and the idea that we're not quite clear on when we're going to get that next cut if we do it all?
Frank, I think the market is looking for more stimulus. And if we're going to get this sort of hawkish cut, that's the widely expected outcome. But if there is no sort of roadmap forward for additional cuts heading into January, heading into the next several Fed meetings into Q1, I think the market might be a little bit disappointed. And we may end up see sort of the top side of this market sort of be compressed and not get another big leg higher here in this market. We just may consolidate.
Now, when you say the top part, you're talking about the mega cap stocks. What part do you see getting compressed? And the fact that we are getting this cut, shouldn't that help the cyclicals, regardless of the path forward, but at least give a near-term boost to those names?
Yeah, Frank, what I'm talking about specifically is just the overall popular averages, whether we're talking about the Dow, the S&P, tech stocks, those kind of stocks will probably not get another big leg higher if this is a very hawkish message and the Fed basically says, hey, we're one and done and we're basically on hold from here until the next Fed president is announced and sworn in sometime in February. But if we do get a cut, it should definitely help mid and small cap stocks. And the Mag 7 stocks, Frank, I think are probably going to continue to lag. They have not been the best performing names in 2025, and I don't think they're going to be in 2026.
All right, I think that explains, Craig, your 2026 price target for the S&P at 7150, about a 4% rise from where we closed yesterday. I also want to go to some data that you shared with us. After the S&P has had a 10-year return, a 10% return over 3 straight years, the median return on the S&P is just 2.5%. Your outlook's actually a bit more bullish than that. Should we be concerned about these historical trends? We often bring them up when they're positive for the market, but this one, it's kind of it's kind of something that makes you step back and say, well, we've had a great run for 3 years. Maybe it is time for some consolidation that you're talking about. Maybe it is time for a pullback.
Yeah, Frank, we put together our Outlook piece and just published it last night, and we're here with you this morning. And when you put all the pieces together, not only from a midterm election year, but 3 years up in a row, the returns for year number 4 are typically not very good. A bottoms-up point and figure model that we use to set our price objectives like we've been doing for like the last 20 years. All signs, when we look at this from a technical, from a fundamental, perspective suggests that 2026 is probably going to be a year of higher volatility, probably strength in the first half. And then typically when you get into the third quarter is when you typically get a pretty good drawdown before midterm elections take place. So again, it's going to be good in terms of the bull market still remains intact, but I think we got to all sort of recalibrate our expectations that mid-single digits is probably the reality of what we're looking at for 2026.
All right, part of that recalibration, I'm going to go a little bit deeper in your note. I think you're understating your note right now. You said there could be a pullback of as much as 20% sometime around Q2 or Q3. What's the catalyst for that kind of pullback? And then what's the catalyst for the recovery? Because you see the market's positive for the full year.
Yeah, Frank, what the catalyst for that drawdown is probably going to be midterm elections. It is what we have typically seen in midterm election years is there's traditionally been about a 20% sort of drawdown that happens intra-year. Perhaps the current administration does not retain the House, the Senate combination of those. That could be some of the catalysts for that drawdown. And then ultimately, once that passes, we could also start to see some additional Fed cuts that could eventually be a catalyst to push the market back up. So again, more volatility, great for traders, great for individuals that can be patient, but it's not going to be the same roadmap that we saw in 2025 or even 24 or 23.